high-integrity carbon markets have the potential to mobilize capital towards driving climate action. But today, the market suffers from significant trust deficit. This panel, we're going to talk about change. Change to reinvigorate the carbon markets and overcome paralysis. We're going to talk about it in 3 segments. The first is in terms of harmonizing standards and frameworks. Second, in terms of how we can institutionalize carbon. And lastly, use technology as an enabler for change. So we start first with you, Mark. Let's talk about the issue on the lack of harmonization across standards. It causes a lot of confusion. It's messy. What in your mind is this ideal state of a world where standards are harmonized? What does it look like? And what changes do we need for us to get there?
So thank you for the question, and thank you for having me here today. That's quite a big question. But I think, as others have said in earlier panels, in different ways, the fact that in 2025, 37 years after we started negotiating international climate change, we're still relying on any kind of voluntary action at all is just a testament to our collective failure, and people have said that before. So the obvious answer to your question is we need to get to a joined-up, regulated system driven by incentives and policies that not only enable but require companies and others to look at carbon markets as part of a broader framework for their decarbonisation. Part of the problem we have at the moment is that there's a whole bit of setting of standards and guidance and principles and so on and so forth for how companies should set targets and decarbonise. And then there's a whole different world, which we are part of, which is how do you use market-based instruments and how do you use carbon credits and so on and so forth. And we have become, over the last 3 or 4 years, almost enemies of each other, rather than thinking, how do our bits fit together for the greater good? Because after all, it's all very well company A or company B being net zero or carbon neutral or zero, whatever it happens to be. But if the rest of the planet's continuing in its merry way emitting, then we're not solving anything. So I think one is a principle we need to look at in the round. We need to look how carbon credits, market-based mechanisms and decarbonisation go together and how they can be put together in a way that they mutually reinforce. There is evidence, and I think people have mentioned this earlier, that companies that do invest in market-based mechanisms in a good way, and I can come back to that, set themselves an internal price of carbon and suddenly find huge opportunities to reduce emissions that are profitable and drive greater efficiency and productivity. So the two can go to work together, but it requires all of us to say, okay, we don't need it to be perfect. We need something that we can track and we can improve over time, but we need something also that is interoperable and harmonized internationally. Now, it doesn't mean every country will have exactly the same standard or every sector will have the same standard or exactly the same policy, but they need to be harmonized in a way that allow companies that operate in many markets and a market that we hope will operate globally and therefore drive quality at low cost to work together. So it starts with a philosophical point of view. So we need to get over our philosophical differences and then turn that into pragmatic pieces of policy and guidance that can be used everywhere.
Okay, I want to get your views as well, Hugh. You are REIT Gold Standard, and that's an international standards body for carbon markets. We're also seeing a lot more regional and national sort of carbon standards as well, right? So even within this region, we have the ACCF, ASEAN Common Carbon Framework as well, coming up with carbon frameworks for this region. How do you sort of see regional and national standards as well, harmonizing with international standards? And is that also practical or even fair? Because different countries have obviously different challenges and priorities and different stages of development as well.
Yeah, I think this will be one of the critical questions that really defines how things develop over the next few years. So as Gold Standard, we set up a carbon market regulation tracker a few years ago, which tracks regulations related to the carbon market. And if you look at that, there were very few before 2021. And since 2021, we've seen an explosion. We've seen an explosion of regulation across the world. And those don't always look the same as each other. And you'd expect that because these are national regulations. You'd expect there to be kind of national approaches which are in there. But it starts to get a bit worrying if we're not seeing those elements of harmonization which support an international market. And that's what we are seeing right now, where we sit in Gold Standard. And this is a real change from where we were a few years ago. If you go back to 2020, 2021, we were at the time of the Task Force on Scaling the Voluntary Carbon Market. It was all about harmonization. And in those last 4 years, we've seen a little bit of fragmentation coming in here in a way which is a little bit concerning. So from our side, as we look at this, there are two key things which I think are really fundamental. One is this harmonization around standards. We have a lot of really great examples now of meta standards or similar which can be looked at the international level. We have ICVCM, we have Klier, we have these examples which governments can look at and say, okay, there is excellent work which is going on to look at what best practices and standard setting. And seeing this reflected in regulation, I think, would be very valuable. And we are seeing this in some places, which I think is good. And then the second point is around the infrastructure question. And this would be very interesting to see how this develops over the coming years. We're in a period now where governments, for Article 6, are having to set up national registries. We're in a position where we have new standards which are coming through with their own registries. And a big question is, how does this all fit together? Because if this is going to be an international market which will scale up, we need something which brings these systems together, connects data points. And again, there are some good examples here, but also this is something which needs focused attention. It needs collaboration. So some of the examples, like the example in this region, is really positive of governments looking to work together to make sure there is this starting point of harmonization.
It's great to hear that, because in a fragmented world, it's going to be extremely messy, extremely disorganized, and I think that's not going to be good for carbon markets. Let's move on now in terms of how we can think about institutionalizing carbon. And the way I think about institutionalizing carbon is really making carbon a lot more commercial, a lot more scalable and replicable across. And I like the framework that Ravi used earlier on the building blocks of supply, infrastructure, and demand. So we're going to start with supply. Daniel, question for you. South Pole obviously has a lot of experience developing a lot of carbon projects globally, I think more than 850 projects. One of the issues that a lot of these projects face is bankability, right? Some of these projects are not scalable. How do you think about, how can we actually make a lot more projects commercial, right? Like, what are some of the key things that, investors need to look out for as well?
So, Ashley, thank you very much, and thank you everyone for being here. It's I think a great energy in the room, which we need. Also, big thanks to Fred for picking the penguin as the logo for today, because some people know that the penguin is actually the company symbol of South Pole and trademarked. So you probably will.
Daniel was supposed to, yeah. And Daniel, you were supposed to come in your penguin suit. Right?
I know, but I'll disappoint this year. I'll do that next year. So
we'll hold that to you.
Joking aside, I think if I listen to the last 2 to 3 panels, it sounded very negative. And actually, it's not the sentiment that I have at the moment. The progress that we made, even in the 12 months that I'm in this role, so I took on the role as Chief Executive of South Pole on the 1st of May last year. And I think the market made huge amount of progress, and maybe I see that more because I'm so fresh in the market. And with that, I mean a few different things. I mean, we still transact with over 1,000 clients every year that purchase credits. They may be a little bit less vocal about it at the moment. They may be a little bit more subtle how they do it, but people are still transacting. But what even more important, and linking to the question that you asked me, we probably get a call from a large pension fund, a large infrastructure asset manager a week at the moment, looking to deploy large amounts of capital. And that is really encouraging, because that means they're reading the market in the next 5 to 10 years in the same way that I think many of us are reading the market. They're looking for abilities to deploy that amount of capital. And that now comes to the question, so if that's the exam question, and I hope I'm not overly optimistic on this, but if the exam question is capital is there, it's looking to be deployed, but actually is looking for scalable solutions that have characteristics that are investable and bankable, then we're having a very different discussion than we had maybe in the last panel, where we were arguing about removals and reduction credits, where I think we all came out, it's an and not an or. So I think we're looking to solve a question 5 to 10 years, really, really encouraging. Next to 12 to 18 months, a lot of messiness to work through. And so the 3 issues that I identify in my daily work are issues that we all have, I think, discussed today. And I'll repeat them very quickly and then hopefully move to answers. But also many of them have been said before in these panels. And that's really encouraging, because I think we're saying the same thing, and that's actually for once a good thing, because we're honing on the core issues. First, yes, we have a fragmentation of frameworks, of regulatory responses. And that is very natural. After every crisis, you over-respond because everybody wants to respond. And I think in this market, it was incredibly healthy because we did build a level of confidence back into the system. I think we heard that a few times. The integrity discussion isn't a discussion anymore that we have every day. And I think that is good. But we now need to use the momentum that we're having around Article 6, around ICVCM, to consolidate this back to a global standard. Because Tom is sitting over there, and he spoke on the panel earlier. I worked in banking for over a decade. What works in financial markets is the fact that a pair of FX is a pair of FX. A derivative is a derivative. A bond is a bond. There are nuances, but it's an instrument that is recognized and has a global standard. So I think that's a very clear, action plan, and maybe the run-up to COP with the momentum around Article 6 is maybe a great momentum where we bring together Amy, who's in the room, and obviously the PACAM team. The second problem that we have is also quite easy to fix in my mind, is that investment structures, deal structures aren't repeatable. Right? We're really, really excited at the moment if we do an outcome bond with the World Bank, if we do a first of a kind of something, but that's not how you scale a market. And I think, again, removals, let's take removals for a moment, it feels and looks like infrastructure. The people that come to us and want to invest in this are often infrastructure investors. So I think we need to start to borrow more of the playbooks that worked in financial markets, copy some of the asset classes that work there, and don't reinvent everything. And that, for me, also means that we need to get sort of those regulators like Ravi on board, because you build trust in the market if you have regulators that essentially say, I looked at this, I'm your second and third line of defense. You build trust with the end buyer. And then I think we come to the third one, which is the hardest one, which we discussed a million times. It's demand, right? Look at renewables. How did renewables scale? In the first instance, government said, I'm your buyer, right? I give you an offtake price. That's how solar worked in Germany. That's how offshore wind took off in the UK. And over time, the corporate demand came in very clearly. I'm really, really encouraged by the momentum that we're seeing at the moment. And actually, I think what happens in the US accelerates that momentum that we talked about in Germany, in France, in many other geographies where governments are now saying, wait a minute, I need to deliver growth, I need to invest in competitiveness, I need to invest in energy security, I need to build up infrastructure again, I still want to deliver net zero, I need a functioning carbon market. So I think we see governments come back, and Mark, you've done, I think, a lot of work with the UK government. I think they came out with a really encouraging consultation. So I see governments coming in, which is absolutely essential. But also, I think you heard a little bit from a number of the panelists, the early positive energy that we get from the new SBTI. I had lunch with the new CEO, and I get a very, very different energy out of this, that it's about action, it's about pragmatism. We already banked in 1.5 degrees, sadly. We cannot have another 10, 15, 20 years of debate of or. We need to embrace that end, and I think that's really, really important. So have we solved all of this? No, but I think the combination of compliance markets emerging and a more action-oriented voluntary market coming back, and those two markets converging. Many of you, I think, heard of the proposed changes in the EU ETS, where you can bring in carbon credits into the ETS in the same way that you do it here in Singapore with the tax. That's the real way to unlock the market, because it's no longer the chief sustainability officer has it discussed. It's the CFO that says, well, actually, that's the better way of doing it. I'm investing into long-term offtake. Long-winded way of saying, I think we're in the springtime. We need to fix a few of these things which are all in motion, and we're obviously running a little bit out of time because I think all the right people are in the room. COP30 this year is going to be a carbon COP. The president of COP already said it. That gives us 6 months to get our act together.
Yeah, so we definitely should get our act together, right? So Oi-Yee, I want to talk to you about infrastructure. for us, when we think about a high-functioning market, we need things like transparency, we need things like integrity, but also liquidity as well, right? But we don't quite see a lot of that in the market today. You joined CIX last year as CEO and came from prior financial market experience as well. Maybe help to draw some parallels. What do you think about the market that we have today in carbon, and maybe how does it compare to financial markets? What change, can we have in the market to unlock some of these bottlenecks, right, that we're facing in infrastructure?
Yeah, we can talk about sort of various parts of financial markets, but I'll look at the equity markets just because it's something I'm a bit familiar with. If you're a fund manager, you've been told to buy shares, right, for a variety of reasons, and you're compelled to buy. So you go to SGX and you go to NASDAQ, and there are choices that you can make, and they're all very transparent. There's disclosures. There's a price reference that you can decide whether it's overvalued or undervalued, and you make these decisions, right? If you don't, you get fired. So it's very simple. In the securities world, it's very simple. In financial markets world, it's very simple. In the commodities market, you have to buy or you have to hedge. Now, the part of the issue, or actually the issue with carbon markets today, I think starts with the demand piece, which is what is the compulsion to buy? What is the need to buy? And at the moment, because of the conflicting signals that you get, because of the, lack of harmonization of standards, corporates with all their best, intentions, look at the space and go, wait a minute, do I need to buy? And therefore, I think we need to see, and all the talk, and I think, Minister Tan said this yesterday, and I think it's great that we're going to get some VCM guidance in Singapore, is so that companies feel comfortable or feel that they can buy or should buy because they themselves have targets that they want to meet, right? So that's one part of the demand piece. The second part of the demand piece is therefore, okay, I've decided that I want to contribute and I want to sort of help and buy carbon credits. What do I buy, right? And I think today, the large corporates who have very large sustainability teams and resources, they know where to go, they know what strategy, they know how to build a portfolio, they know how to sort of call the project developer and put together portfolios. But what happens to everyone else? 90% of the corporates who are not on SBTI don't even know where to start. And because the market is very fragmented and the market is what we call sort of off-screen, any corporate who don't have sufficient resources struggle to even start that process of buying or procurement or strategy or portfolio curation. And so I think the market infrastructure needs to evolve to change that. If you think about the parallel in the securities world, there are obviously large exchanges that are sort of somewhat nationally endorsed. There's a lot of trust in the way that projects have been onboarded. There is a lot of trust in how participants participate in the market, both on the sell side and the buy side. And I think the carbon markets should eventually evolve to that, because if not, it will not be a scalable market, and it will not actually be a bankable or a financeable market.
Great. So I think Daniel and Oi, you've both touched on demand as well and how it's so important to have the right demand signals for carbon markets to really take off. And I want to turn to you, Mark, on your views on that, right? Because I think what we're hearing is that a lot of corporates are either buying but being quiet about it, or being afraid of buying because they don't want to end up being, in the press for bad reasons, right? So do you think that having the right guidance, whether it's like the VCMI claims code or any broader guidance for the industry, can actually help corporates feel safe? Like, do they have enough air cover for them to be able to be shielded away from all these media attacks?
Okay, so I think the guidance is the starting point. So I think if we think 3 or 4 years ago, the reason companies invested in carbon credits, in the voluntary market at least by and large, was for some reputational brand value benefit. And I think most companies would say that's pretty close to zero at the moment. So if you're thinking, I mean, this is a theme that goes through all the panels, that you're asking companies to invest in something that is not ordinarily bankable without a carbon credit that has some sort of problem associated with it in the minds of the public. So that, I think, is why we're all saying, no, we're looking at regulation, we're looking at policy. The work that we do and that ICVCM does has been very important from the supply and the demand side to have something that can be applied globally. And I think anyone who heard me when I launched the Scope 3 guidance last week was saying, this is what we have developed on the basis of analysis of companies with SBTI targets. That doesn't mean it's going to be right for every sector in every country. There's a huge variety between levels of development, available cost and availability of capital, and so on and so forth. So the guidance is a starting point. But if companies want to have a really, a visible value proposition, a business case for investing in this, which isn't reputation, it's going to be either it reduces the cost of compliance with something, it provides an opportunity to reduce the future cost of compliance with something, or they assume that the value of credits will go up in the future and therefore they're using them as an investment. So for that value proposition, that business case to exist, I think we're looking at real regulation and real policy. Guidance is a good starting point, and if guidance is a way to not only have harmonization across the voluntary bit of the market, but a way for countries to come together and say, okay, here's a set of principles that we will all apply. We'll have different, as Daniel said, we may have different policies in different places, but as long as they recognize the same general quality of credits and the same step-by-step mitigation hierarchy-driven process that we use for our VCMI guidance, whether it's exactly the same is not important. It's that it's similar enough, understandable enough, and interoperable enough. And I think that comes through policy, whether it could be the approach that Singapore has taken with a tax. It could be, as Daniel's mentioned, perhaps in Europe allowing some portion of credits back into the ETS. It could be a direct requirement. You tell every company that they've got to offset 1% of their emissions with high integrity carbon credits. There are lots of different ways you could come at that, but if the underlying guidance, whether it's the core carbon principles and VCMI's guidance on the demand side, if that permeates all of it, then you've got enough interoperability and enough harmonization. Let me just make one final point.
Okay.
One of the reasons we have the fragmentation, I think, is because every time, say you produce a standard and I go, well, I like 98% of it, but I don't like 2% of it, so therefore I'm going to create my own one, or I'm going to really insult you, and we're all doing this. Come on, we can get it 90% right. Let's try. And then we'll make improvements over time. And that is what, as I've said, we've seen in the last 20 years. The methodologies and the monitoring techniques in 1998, when I started doing this, were lousy compared to what we've got now. But that doesn't mean that it was wrong. It means that we created a process of innovation and continuous improvement, which we have in every sector of society and every part of the economy.
Great. So I think, Mark, you mentioned that about how the guidance is a starting point, but also the importance of regulation and policy around this. So I want to bring up a question from the audience. What role should governments, multilateral institutions, and central banks play in making carbon a core part of the economic system? And you talked about also how there has to be a business case, right, for the demand to happen. So maybe open up to anyone who wants to take this question, right, about the role of, and maybe we can have the question up on the screen. What role should governments, multilateral institutions, and central banks play in making carbon a core part of the economic system?
Well, I'll start with the governments. There are three pretty different sectors we're talking about here, but from the governments, it is saying either that you can use carbon credits to meet some part of your corporate climate transition, or that you must. And either way, that creates a value proposition for the company. And I think that's just repeating what we've said before. But do others want to talk about the banks and the central banks and the MDBs?
Well, okay, well, I think governments need to agree if this is a critical part, whether it's Paris Agreement, Article 6, NDCs. I think governments need to think about how to distribute that, or how to sort of work with their own economic environment to support that, right? I think at the end of the day, it's almost as simple as that, because there's no point government saying, well, everybody should just do voluntary, and maybe we will meet NDCs at some point, or maybe we should just, and have a light touch versus what they need to achieve on their own on their own commitments. You can't have them both ways. So at some point there needs to be a thinking and a convergence of what is voluntary and what is compliance, and how do governments work with companies to make that all happen in a more coordinated manner. And that's not going to happen, by just wishing that it would happen, that corporates will, out of their goodwill, meet their net zero targets.
Yeah, Hugh.
Yeah, I mean, so this gets just to one part of this question, but I think when governments are setting up effective regulatory frameworks at the moment for carbon markets, and this is kind of more those who are on the side of hosting projects, I think it's when they're very clear about how carbon finance fits with their strategy, not only to meet their NDC, but also their longer term development strategy as well. And so they're clear, this is where we want investment, because this supports achievement of our NDC, but it also supports these other goals that we've got as well. And that's really what you want to see, and I think that's what everyone wants to see. It helps the governments, it helps investors, project developers, because they know where their investment is going to be supported by the government. And you can see this on the side of governments looking to attract international investment, but it's also done to a certain extent in the EU, where kind of by integrating removals into the ETS, you can create that demand signal for action which you want to take place. So I think that kind of conscious looking at carbon and saying, how does this fit in with my overall plans, is really important. And I think kind of linked to that, where this is done well is where it's not just the Environment Ministry, it's the Finance Ministry as well. And I've worked in both in the past, and having the Finance Ministry involved is really important for these kind of choices and looking strategically at it.
One more addition from me. I think governments have an important role to play to make this real again, right? We sit in our little acronym world, and that's great. But that's why I really love the work that we're doing here in Singapore on the coal to clean transition, right? And obviously we're announced today. We were the technical partner who helped develop the standard. Everybody will understand that shutting down coal-fired power plants early is good for the climate, is good for long-term prosperity in the country because you create new jobs with renewables, you manage the just transition, and it's also great for air quality. There's so many benefits, and I think it's important that we talk about those examples, and there's so many people in this room. Nat, I see you over there, right? There are many people in this room that have been fighting for those kind of actions for such a long time, and I think people will look at this and say, yeah, I get why the carbon market is really instrumental for this, because otherwise it would never ever happen. Like why would a utility company ever shut down a coal-fired power plant early? They have shareholder obligations and everything. So those are the stories that will change, in my mind, also the perception of what the carbon market can do. Because we still live in this world where we're defending the carbon market. We're sitting here the entire time defending it rather than, I think, being a bit proud of the power of this market and giving people the confidence to come back to the market to unlock the amount of change that would otherwise never ever happen.
Great. You're getting ahead of this panel because that's probably the discussion for next panel. But coming back here on, I want to talk about technology, right? I mean, we're in 2025, everyone's talking about AI, robotics. How is it like in the world of carbon? And maybe Hugh, tell us a little bit about how Gold Standard is thinking about this, right? Are you already using things like digitalization, digital MRV, AI maybe? Like how is it actually helping to create more efficiency, right? Or even cut costs to some extent. But also maybe talk through some of the considerations and challenges as well, right? Is there, data accuracy or like reliability by using some of these technology as well?
Yeah, I think this is one of the areas which goes back to the point which Daniel made earlier about where things will look in 5 years' time. My hope is that this market, in terms of digitization, looks fundamentally different in 5 years' time. And that doesn't just sit with standards, but a lot of that sits with us to make sure that we have the certification process that enables some of the technologies that can really be transformative in terms of efficiency and accuracy. And we're very much at the starting point of this journey. As Mark was saying, this is continuous, so things have already improved, but they need to improve a lot further and a lot faster than they have so far. So some of the areas that we're really interested in the next few years. The first is looking at how digital MRV can be mainstreamed across all projects. We have some examples of this already in Gold Standard projects. We have some pilots running right now. We have projects in the clean cooking sector which are using monitors for real-time data and are seeing kind of much more heightened values in the kind of high valuations of their carbon prices. And I think there is some connection between the two. We're very interested in how AI will come in and how that can play a transformative role in the carbon market. We commissioned a study last year looking at how artificial intelligence can reduce some of the barriers that we know are there for, in particular, smaller project developers looking to develop projects, get through certification, get through feasibility, all of these things. There are different ways in which AI can come in and support. And I was speaking to a project developer the other day, a newer one, who said that their AI team is almost as big as their kind of technical standards team. So they're really looking at how AI can come in and how it can play that role, kind of enhancing the project development process. We're very interested in how we can do more to bring value to the data which we hold as a standard setter. We sit on reams and reams of data, which is all there in PDFs. And as the market grows, as insurance comes in, as banks come in, this is data which is valuable to help to understand risk. And what can we do as a standard setter to enable access to this in a more structured way? And then finally, the point which I made earlier, I think we do have a big question as a market about how registry infrastructure, market infrastructure will evolve and how interoperable this will be. And so this will be a big focus for us over the next few years, looking at how our systems need to be updated and enhanced to be able to connect to national registries, to be able to provide the right service which the financial sector expects.
Great. So I guess that's a very interesting perspective from technology, from an enabler perspective. Maybe let's talk about technology from the deep tech perspective, right? In terms of say carbon removals, etc. Daniel, I want to hear your thoughts on this because it's usually there's always a green premium that comes with a lot of these new technologies, right? How do you see the role of carbon markets, sort of helping to bring down some of these cost curves down, right, for some of these technologies?
Yeah, I mean, I think you're at the heart of why the carbon market exists, right? I mean, what you describe summed up in the word additionality, right? We need to evidence that the carbon market goes to problems that would never be addressed otherwise. That's why I love the work that we're doing on coal, but also we're working on cement decarbonization. That's why obviously a lot of the removal technologies are such obvious examples to move money into areas where either there will never be an economic mechanism, or you bring scale into technologies that otherwise wouldn't function. Again, I brought the renewable example earlier. Governments did the job there. In our case, governments aren't doing the job at that level, especially because often the projects sit in different jurisdictions, and therefore you need the market mechanism. I mean, for me, it is as clear as sort of the original idea of setting up the carbon market was to move technologies along that for private investors at the moment just don't make sense without a carbon market. But I think it's important that we don't just think about removals. Removals are absolutely essential in this debate, but again, the coal discussion, the cement decarbonization discussion, steel decarbonization, hydrogen, all these technologies can be unlocked with the carbon market, not alone, right? It's not the only silver bullet, but it's one of these additional revenue streams that these projects often need to make them viable.
Yeah, and I think just to combine what you both said, it works really well, that focus on how do you use the carbon market to proof of concept, to disseminate, to show people how to use technologies that they haven't had access to before. I mean, people often talk about the solar explosion in India in the first decade of this century because of CDM projects. And I think it goes to what you were saying, Hugh. It's think about technologies that I as a country or as a sector am going to need. And it's not just decarbonisation technologies. Everybody needs irrigation. How do you do irrigation in poor countries without having to use diesel gen sets? How can you put in solar? And therefore then think in the context also of agricultural methods that are less carbon intensive, which then lay the foundations for countries, regions to be able to do it without carbon finance in the future. So I think it's that strategic approach you were talking about and combining those two together, that's where carbon finance can really have much bigger bang for its buck.
Great. So we're running out of time, but I want to leave one last question with all these panelists. If there's one change that you could have in carbon markets, what would it be? And don't cheat, just one. Okay, so maybe you start with Oi-Yee.
I think that if the world tomorrow all agreed that we all need to be vested in the carbon markets, I think that would change a lot of things, right? If you think about what liquidity means and transparency means into the financing of these projects, it also means that everybody needs to have a collective vision or collective investment into the carbon market. So if everybody woke up tomorrow and all agree that we need to do this together, I think that would be tremendous.
Collective agreement on this. Okay,
Yes.
Daniel?
For me, it's very clear. We need to reward corporate leadership again. But at the moment, as the chief executive of a large listed company, you have zero incentive to lead on climate, because the best thing that can happen to you is nothing. And the worst thing is massive reputational backlash. And that's not just carbon markets, it's beyond, but carbon markets in particular. And we need to bring back a way of rewarding people that step ahead. And actually, what I hear sort of in the run-up to COP, where the COP president, who also leads the BRICS summit, I think there is a counter-narrative again coming where leadership will be rewarded again. Especially, sometimes you need a culture war to reward that again. And I have some hope that we can do this, but we also need to have confidence in this room to again praise leaders.
The carrot that we all need. Okay, Hugh?
I mean, mine is very similar. I mean, if you look at what it will take to get us past the paralysis, if that's what we're in now, it is that clear demand signal, and that can come from the voluntary side. It can come from there being a clearer kind of reward, a clearer incentive on the voluntary side. It can also come from compliance. And I think this gets us back to the point that we were on earlier. I think moving past this voluntary and compliance to talking about carbon markets will be increasingly important, because that's the role that we play as a standard setter. Wherever it comes from, that demand signal, I think, will kind of provide the incentive, provide the momentum to address many of the other challenges that we're seeing right now.
Demand signals and...
I would just agree. I would think if I was going to have one thing this
one,
year,
just one.
I would like 6 leading industrialized countries to come together and say, we are going to require or allow companies to use carbon credits as part of their compliance obligations, and then drive the market like that.
It sounds like 6, but okay, I'll give that to you. All right, time is up, so please join me in thanking our speakers today for the wonderful session.